paper 2 of June 2022. And this is a question paper from the Gauteng province. So we start with the instructions that we have in this question paper. So instruction number 1, answer the questions as follows in the answer book. Section A is compulsory. You have to answer every question that is on section A. And then section B, answer one of the two questions. So there are two questions that are there in section B, and we answer one question. Then section C, you answer one of the two questions again. Two questions in section C, then you answer one question. Remember, section C is our essay section. And then I will move on to the first part of our question, which is the multiple choice question, which is our section A, with 30 marks, which requires you to spend on average 20 minutes. So the first question is, which of the following is not an example of businesses in an oligopoly? So remember, in an oligopoly, we have businesses that are few, and obviously these businesses are dominant. So in that case, in this question requires us to identify which is not. So we'd like to identify the industry that has no few firms. Since we are saying oligopoly, one of the main characteristics is that we've got a few firms that are operating in that market structure. So if you look in the banking sector, C says FNB, Capital Credit Bank, which is that the banking sector is not described by few firms in the local economy. So that makes C not indicating businesses that are in an oligopoly. So this is what we have. So question 2, a characteristic of a monopoly is that, remember, in a monopoly, we have got one firm that is operating, and the firm is producing or selling a unique product. So the question is saying, what is the characteristic of a monopoly? So we try to see which one best describes the characteristic of a monopoly. So it's going to be saying the nature of the product is unique. So the product has to be unique. That makes it difficult for other firms to penetrate in that market. And that firm that is operating as one firm will remain operating as an individual firm. So basically, that's what we have on number 2. Number 3, a graph which shows the efficient use of opposable resources is, so you see that we have got the production possibility cap. So production possibility cap shows efficient use of resources. Remember, when we have points that are inside the PPC, remember a typical PPC is a PPC whereby we have our vertical axis and our horizontal axis. And it usually bows outwards like this. So any points that we see inside the PPC represents inefficient allocation of resources, and then any points on the PPC indicates efficient allocation of resources. So basically, it shows the efficient use of opposable resources. So basically, we have C as the correct response. Then we move on to 1.1.4. The highest price at which a product is allowed to be sold is known as remember, we have the maximum price with the minimum price. So obviously, when we are talking about the highest price at which a product is allowed to be sold, it will be, if you check according to responses are given, we see that it's a maximum price. Remember, a maximum price is set below the equilibrium point, and no firm is allowed to charge a price that is greater than that one. So basically, that's what we have in terms of the maximum price. So we have maximum price, which we have on C. Then moving on to the next part, which of the following is not a reason for market failure? Which is not a reason for a market failure. So you try to see according to the responses are given, but according to the question saying which is not. So we have to identify the one which is not a reason for market failure. So we have got under supply of goods and services, which is a reason for market failure, and unreasonable prices. It is a reason for market failure. The distribution of income and wealth can be, but if you look at D, legislation is the one that is not. So we have a D. We'll move on to the next part, which is going to be our matching words. So the first term that we have is Adam Smith. So basically, what does Adam Smith is known for? Is what we are going to try to check according to our column B. So if you check there, you'd see that you have D, the father of the modern economy. That's what Adam Smith is well known for. So we have D as the correct response. And then we go to globalization. Globalization is whereby an economy is engaging in international markets, is trading with other nations, that is exchanging goods and services with other nations. So basically, we check within that context what we have. We have A, which is saying markets are not limited to only certain countries. So we have A as the correct response. Then we've got opportunity cost. We know that opportunity cost is the cost or the value of the best alternative that has been forgone or that has not been chosen. So you've got two options. You choose one option. The other option that you did not choose becomes, and its value becomes the opportunity cost. So according to responses given, you'll see that we have further responses that we have just as we go down. So we check which one is the most appropriate. In terms of opportunity costs, you'll see that if you go to F, says the value of the alternatives that were given up as a result of a choice. So we have F as the correct response. Then we've got efficiency. We know that efficiency is associated with the effective allocation of resources where there are no wastages. So we'll try to see again which one do matches that. We have B, all of the economy's resources are being used effectively. So that's what we have. So we have B is indicating efficiency. Then we've got the ad valorem tax. So ad valorem tax, we try to see what explains ad valorem tax, but we know that ad valorem tax is when tax is calculated as a percentage of the product, which is given as our E. So we have E. Then we go to social benefits. We'll try to see which one do matches social benefits. So this consists of the total benefits society gains from the consumption and production of goods or services. So we have C. And on 5, we have E. So this is what we have for this part. And then we move on to the next part, which is on coming up with a term from a given explanation. So 1.3.1, the exchange value of a good stated in terms of money. This is the price. So we are saying price. And secondly, products that are used together with other products, these are complementary. Complementary goods, we say these are goods that are being used at the same time. So we have a car and petrol. This is a typical example of complementary goods. So we have complementary. So basically, on that one, we move on to the next one. Goods that benefit everyone that are available to everybody. These are public goods. And then lastly, payments made by the government to promote the production or use of a particular product or service. These are called subsidies. So they come in the form of a government expenditure, which is an instrument that is used by the government. So we have subsidies. So this is what we have, and we have a total of 20 marks on our section A. So from there, we are supposed to move on to the next part, which is going to be our question 2. So question 2, the first question reads, name any two requirements of the establishment of a market. So obviously, when a market is being established, there should be buyers and sellers. Remember, a market is a place where buyers and sellers meet. So that requirement is necessary. At least one buyer and one seller should be there. And also sellers must have goods or services to sell and are willing to sell. So those typical requirements should be there. So our question only requires two. So according to our answer section, we see that we should have at least one buyer and one seller. Sellers must have goods or services to sell and are willing to sell. Buyers should have the means or to pay for goods are very important. Agreement in price and quantity are between buyer and seller. And transactions should be formalized according to law. So basically, these are some of the requirements that are there. So we go to the next one. It says, how does a minimum price benefit businesses? So remember, when we have a minimum price, we have a scenario whereby we have a price that is being set above the equilibrium point. So minimum price typically, we have our demand curve and we have our supply curve. So this will be our supply and this is our demand curve. So this will be the initial price level, which is the price equilibrium. And then a price is set above the equilibrium point. So this one becomes the minimum price. So in that case, when the price is above the equilibrium point, which means the price has been increased and it will benefit our businesses. They will earn more revenue from selling one unit. So obviously they increase their supply. So at the end of the day, you're going to see supply being greater than demand, which is indicated here, where supply at this point is greater than supply is greater than demand at this point. So basically, this is going to create excess supply. So our first point is saying at a higher price, businesses will make higher profits, which is clearly, and then minimum prices will lead to an increase in production supply of the product. So basically, those are the 2 points that we have on that part. Then we move on to the next question, which is our 2.3. Start the following graph and answer the questions that follow. We are given a graph that we have here. We are seeing that we have got total utility on the vertical axis. We've got quantity of chocolate bars that we have on the horizontal axis. First question says supply in appropriate heading for the graph. But we are seeing that this is a total utility curve. The curve that we are having here is the total utility curve. So that's the title that we have. So we are saying this is the curve that we have, and we are saying it is the total utility graph of chocolate bars. So this is the title that we can give. So the second question is identify the chocolate bar with the marginal utility of 0. So marginal utility is the additional satisfaction or the additional utility that is gained from consuming one extra unit. And when we have our total utility being the same, not changing, it means we don't have any additional utility that is there, which means our marginal utility will be 0. So we check where we have total utility which are not increasing. So if you come here, you'd see that we have, at this point, we have got at the fourth chocolate bar, we have got total utility being 140 as indicated. And then again, you check all the 50 chocolate bar, which is at this point. We are also having a total utility being also 140. So by consuming the 50 chocolate bar, we are going to have the total utility not changing. So it means our marginal utility is 0. So we are saying the 5th chocolate bar. So this is exactly as we have the chocolate bar number 5. 2.2.3, what does the law of diminishing marginal utility entail? So it says that as the quantity of chocolate bars increases, the total utility will start to decrease. So diminishing marginal utility means the total utility is now decreasing. So we don't have a positive marginal utility. In other words, it is going to lead to negative marginal utility. So basically, that's what we have. So it says the law of diminishing marginal utility says that as consumption increases, the marginal utility decreases. So that's the explanation that we have. Then next point, explain the relationship between utility and demand of a product. So the greater the satisfaction gained from consuming a product, the greater the demand and vice versa. So basically, we have a positive relationship that exists between utility and demand of a product, which means they move in the same direction. When utility increases, demand also increases. So we go to 2.2.5, distinguish between utility and marginal utility. Utility is the satisfaction gained from consuming a good, the power or ability of a product to satisfy a want. And then marginal utility is the additional satisfaction gained from the consumption of an additional unit of a good or service at a certain time. So we check in terms of marginal utility, it is the additional satisfaction gained from consuming an extra unity. So this is extra unity, this becomes extra. And this will be the additional 1 unit are very important for you to take note of that. Then that's the difference that exists between utility and marginal utility. So with that, we need to move on to the next question that we have. So the next question says, start the following graph and answer the questions that follow. So you're given a production possibility curve where we've got points A to D. So we've got apples on the vertical axis, bananas on the horizontal axis. So the first question reads, how many bananas can be produced at point D? So point D, we are having it here. So in terms of bananas, we have 450 bananas as indicated here at point D. So this is exactly as we have in our answer section, as we are saying, we have 450. Then the next one says identify the point of inefficiency. So we are saying inefficiency is indicated by any point that is inside the curve. So we have B that is inside. So B represents inefficiency. So this is what we have. We have B. Then briefly describe the term production possibility curve. So this is the description that we have. And the PPC shows all possible combination of goods that can be produced within a given set of resources. So we are going to see that point C indicates a point that cannot be produced. It indicates scarcity, as we are saying we do not have resources to produce at point C. The maximum that can be produced in the economy are along the PPC, which is A and D. C cannot be produced because the resources are not available. So basically, that's the description of the PPC. Why is it not possible to produce at point C? So we have explained that it's because of scarcity, shortage of resources, and it's also a point that is outside the PPC, so cannot be produced. So that's what we have on that point. Then on the next question, it says calculate the opportunity cost if production shifts from A to D. So you're going to see that according to our graph, when production shifts from A to D, we can see that these are our points with A to D. So we're going to see that we are going to have an increase in the production of bananas. Bananas is going to increase from A to D, will increase from this point to this point. But we see that apples will now decrease from 470 to 260. So we say opportunity cost is the value of the best alternative for gold. So what has been foregone here is apples, because we are reducing the production of apples. So the reduction in apples indicates the opportunity cost. So we are saying 470 minus 260. So basically, that's what we have on the calculation of opportunity cost. So 470 minus 260, we get 210 apples. So shifting production from A to D means we have to sacrifice the production of apples, sacrificing by reducing the production of apples. So basically, that's what we have for that question. Then we go to the next one. Briefly discuss any two characteristics of a perfect market. So in a perfect market, we've got many sellers. So there are a large number of buyers and sellers so that, that nobody can influence the market price with their behavior. So in other words, any firm that is operating in a perfect market constitute a very small proportion of the market, so cannot have any influence to set the price. So that's what we have. The next point, buyers and sellers have full knowledge and information about market conditions, which means they have perfect information, which means they have full knowledge and information. Then next point, there are no barriers to enter and exit. Buyers and sellers are free to leave or enter the market. So very important also. All goods or services in the market are identical or homogeneous. So these are some of the typical characteristics that we have of perfect markets. So we have got other points that we have there, but question only requires 2 points. Then 2.5, draw a graph and explain the effect of if government sets a price, a maximum price on a product. So maximum price is set below the equilibrium point, which is typically as shown in the graph at this point. So with that, we can see that when a price is set below the equilibrium, we are going to have a situation whereby the demand will be at Q2 here at this point, and the supply will be at this point, which is going to be represented by Q1. So in that case, we are going to have demand more than supply. In other words, it's going to create a shortage, which is the difference between the 2 points. So basically, that's what we have. So the question is saying, draw a graph and explain if government sets a maximum price on the product. So it creates a shortage. That is the negative result that is going to be there. The first explanation says sometimes government will set the price of a good or service at a maximum level that is below the market price. So that is the first point that we have. The second point, the government intervenes and passes a law that suppliers may not charge more than the maximum price. So the immediate effect is that the quantity supply will drop. Why? Because businesses are not motivated to produce more, they will produce less, thereby leading to supply to decrease. The shortage caused by the price ceiling creates a problem of how to allocate the goods since the demand has increased. So basically, we also have creation of black markets as due to the shortages. And this creation of black markets will cause also the price to increase again back to the equilibrium point. So basically, this is what we have on this one, which is going to be the last question that we have on our question two. Our question two is yes, 40 marks. So we move on to the next question that we have. Question three reads, give any two examples of geographical markets. So you see that geographical markets, these are markets according to the physical location uh, of that business. So we see that we have got local markets, we've got regional markets as examples that we have of geographical markets. So we have got a list that we have where we're saying local markets, regional markets, national markets, and also world markets. So these are geographical location. Then the second question says, what is meant by production inefficiencies? But whenever we have inefficiencies that are there, it means there are wastages that are involved in the production processes. So we are not having production at the full capacity. So the explanation that we have is saying, if less is produced than is possible with the existing resources, this is referred to as inefficiencies. So less is being produced because of wastages. Then we have producing below the production possibility cap. So it is also indicated by points that are inside the PPC or the production possibility cap. That's what we have on that point. The next question is, study the following cartoon and answer the questions that follow. So we're given a cartoon. The first one is saying, I own the only grocery store in town. Second one is saying, electricity is set for another price increase. So these are the statements that are being said. Then first question says, what type of market structure is illustrated in the cartoon above? So you'd see that in the market structure that we have, we are seeing that we have no identical products that are being sold. The first one is talking about grocery stores, which means grocery products are being sold. And then here we have the issue of electricity. So we see that these are sort of differentiated products that we have. So that can be an imperfect market. And also, we are also having the grocery store is in the obviously in the retail industry, and the retail industry is characterized by the differentiated products that are sold there. So we talk about imperfect market when we talk about the retail industry. So we also have for electricity, we know that electricity is provided by ESCOM, and it's a very unique product. It's associated with a monopoly. So we have a monopoly, and they are indicating that we have got a perfect market or a monopoly. So this one is the imperfect market, and this one is indicating the monopoly. So basically, that's what we have. And then second question, give one example of such a market structure in South Africa. We are talking about ESCOM, as we talked about the monopoly part. So this is what we have. We go to the next question. The next question that we have, which reads, briefly describe the term monopoly. So on monopoly, we are saying we only have one firm that is producing or selling that product. There is only one supplier of a product, and there is no way that consumers could substitute something else for that product, as it is unique. So consumers cannot go to alternative outlets to buy that product because we only have one supplier. So that's the typical explanation on a monopoly. Then briefly describe heterogeneous products as a characteristic of a monopoly. So it means the products in the market are different from each other. So that's the explanation that we have. Then how can having more grocery stores in town benefit consumers? So they can it's obviously based on choice. They can choose which product they want from those alternatives that are there. And we are saying the quality and service of the product will improve due to competition. The supply of the product will increase due to increased competition again. So due to competition, obviously the quality is going to be enhanced. Is they are going to compete to win customers. So in the process, the quality is improved. Due to an increase in the supply of the product, consumers will pay lower prices, and the variety of the product will be sold. So this is the issue of a choice. Then we go to the next part of our question. So on the next part of our question, please start the following image and answer the questions that follow. So the first question reads, identify the text applicable on the products that we have. So if you check there, we have got products that way, but you see that we have got a cigarette that is there, and we have got alcohol as indicated there. So you would see that the text that is indicated in the picture that we have there is excise. So on excise duty, we are saying it is any duty on manufactured goods that is normally levied at the moment of manufacture. That's the explanation on excise duty. And would see that this excise duty is normally charged on tobacco and alcohol. So we have excise duty as our response for that question. Then name any other example of indirect taxes. We can talk about VAT as an example of indirect tax. We can talk about import duty or customs duty, stamp duty, transfer duty. Then what is meant by direct taxation? So direct taxation are tax imposed on the income of individuals and other profits of businesses. That is direct tax. So they are not. It's not tax that is going to be charged directly from the taxpayer. It is charged indirectly. In other words, there is an someone who is in between, or a party that is in between, that is going to collect the tax from the taxpayer and give it to the tax authorities. So basically, that's what we have. Then 3.3.4 briefly explain why government will impose tax on products like alcohol and cigarettes is to raise revenue for the state. Obviously, that's the main objective of charging tax, and also to reduce consumption by influencing consumer behavior. So they want to reduce consumption because these are addictive products that would maybe be to some extent harmful to the health of the public. So basically, in that case, the government would want to reduce consumption of that product. Then to reduce or discourage consumption of harmful products such as cigarettes, alcohol, etc. So basically, that's what we have. So we move on to the next part that we have. On the next part, it is using a graph explain with how an increase in indirect tax will affect the price of products. So we are going to see that when there is an increase in price due to an increase in indirect taxation, we are going to see the supply curve shifting. We are seeing a shift that is there from S to S1. So that is the typical effect that is going to be there in terms of increase in direct tax. We are going to see supply shifting from S to S1. So we go to the next question, say discuss the characteristics of indifference curve. So an indifference curve is always downsloping. When the quantity of one product increases, the other must decrease as the curve represents all the combination that gives the same utility. So you see that the indifference curve shows all combination of goods that have the same utility. So the gradient of the slope shows the marginal rate of satisfaction. Marginal rate of satisfaction. Then other points that we have in particular, we have got higher indifference curves are preferred. There are many different combinations of the consumer choice between the two brands. So a higher indifference curve indicates more satisfaction. So it's going to indicate a combination of goods that have got more utility. So they bend inwards or convex. So we have indifference curve bending inwards or being convex. They do not cross or touch one another. When we have got an indifference map, that is when we're having many indifference curves, we are not going to have a scenario whereby they are going to intersect each other. They don't intersect each other. They show different levels of utility or satisfaction. So basically, that's what we have on 3.4. So moving on to the next part, which is going to be our 3.5. So 3.5, we are saying, how can the government protect consumers against exploitation by the imperfect markets? So the government can investigate charging of abnormal prices and impose fines to firms affected. So that is what we have in terms of imperfect market. So basically, imperfect market is associated with imperfect knowledge. And imperfect knowledge, we are saying this is a lack of knowledge of what we have in the market. So when we say the consumers have imperfect knowledge, we are saying they have insufficient knowledge in terms of what is transpiring in the market. So the government can investigate price fixing by oligopolists and impose fines on them. Laws can be passed that encourage competition and make goods affordable. So basically, this is how can government protect consumers against exploitation by imperfect market. So this becomes the last question that we have on question three, and obviously we are left with our essay question. So our essay question reads, discuss the reasons for an impact of minimum wages on supply and demand in labor market. And our first part is got 26 marks. Then our second part, which is our additional part, give recommendations to government on how they can prevent market failure. So this part has got 10 marks. And obviously, this is our additional part. So with that now we know that our layout of our essay, we are supposed to start with our introduction. So the requirements of our introduction, we have them as we have that. It will be in our question paper as the our introduction is a lower order response. A good starting point would be to define a key concept that appears in the question. So this is the best way of coming up with your introduction. And do not include any part of the question in your introduction. Very important. Take note of and also do not repeat any part of the introduction in the body. So very important. So avoid saying in the introduction what you are going to discuss in the main body. So these are the requirements in terms of your introduction. So I take within the context of our question, we are going to define key term that we have in the question, but we see that we have got minimum wage as a key term. So this is the explanation that we are going to give in our introduction. So a minimum wage, we know that this is a wage that is going to be set above the equivalent point. So it will be a higher than the prevailing wage. So in that sense, the minimum wage is set to protect the employee. So every employer is supposed to charge is supposed to give a wage that is equal to the minimum wage or above the minimum wage. So basically, that's what we have. So we have our introduction is articulated here, whereby we have the explanation of minimum wage, which is part of our introduction, whereby it reads, minimum wage is the lowest wage that an employer is allowed to pay a worker per month. So basically, that's the explanation in the introduction. Then going to our main part is now to discuss the reasons for an impact of minimum wages on the supply and demand in the labor market. So what are the reasons for minimum wages? So we say this is to ensure that they improve the standard of living of the public or the employees. So in that case, we have got reasons for minimum wages that are stated here, whereby we are saying minimum wages are set to ensure that the standard of living of the people, the standard of living of people who earn the lowest wages are not exploited by consumers. So this is the first point that we have. And then secondly, minimum wages reduce exploitation of lower paid workers. Minimum wages decrease income inequality by boosting incomes of low income households. Minimum wages reverse the effects of employer discrimination. So these are some of the reasons for minimum wages. The impact of minimum wages, now we are going to see that minimum wages will cause a surplus of labor because surplus of labor being offered in the market. So when we have a minimum wage, it means that more workers will be willing to go to work, but the employers will not be affording to accommodate those workers. So we are going to see an excess of labor being created whenever we have a minimum wage being set. And then the quantity of labor supplied will be greater than the quantity demanded. So indicating a excess of labor being supplied. The wage rate increases in the market to above the equivalent point, which is clear. The people are being paid a fair wage for their services. There is a fall in the demand for labor due to higher prices. So we've got further impacts of minimum wages that we have that we can also include. So with that, we move on to the additional part, which is our additional part reads, give recommendations to government on how they can prevent market failures. So what are recommendations that can be given to prevent market failures? So basically, a market failure refers to the inefficient distribution of goods and services in the free market. So whenever we have inefficient distribution of goods and services, we have creation of market failures. So in a typical free market, the price of goods and services are determined by the forces of supply and demand. So when we have a free market, we are going to have the price being determined by the forces of demand and supply. So that is at the equilibrium point. That's where we're going to have the market price. So any change that is going to adjust the forces of demand and supply is going to lead to a market failure. So that's the situation that we have in terms of market failure. We are going to have maybe any visible hand, because we are saying when the price is being determined by the force of demand and supply, we have got the invisible hand that is transpiring. So whenever we have a visible hand, for instance, we've got the government that is interfering in the force of demand and supply, in adjusting the forces of supply and demand, we are going to have a creation of a market failure. So what are recommendations to government on how they can prevent market failure? So we have those in our section where we're saying government can provide those goods and services such as public goods, electricity, schools, hospitals, and emissions removal, which may be too expensive for the market mechanism to provide. Government can implement legislation that encourages competition and prohibits high prices. And also the sale of certain products, cigarettes and alcohol to children can be abandoned. So typically, we also have government can protect employees by setting maximum working hours and setting a minimum wage for certain as jobs. So basically, these are the points that we have on the additional part. We have got further points that we have. So finally, we are supposed to come up with your conclusion. So remember the requirements of your conclusion. These are the requirements of a conclusion, whereby it's a brief summary of what has been discussed, analyzed without repeating facts or any mentioned in the body. And also, any opinion or value judgment on the facts discussed can also be correct. Or alternatively, you can additional support information. You can provide additional support information to strengthen the discussions or analysis, or you can come with a contradiction viewpoint with motivation if required. Or you can also come with a recommendation. So any part can be part of your introduction. So you can choose one that is applicable to you. It can be a value judgment. It can be an additional support information. It can be a contradictory viewpoint. It can be a recommendation. So this is how you can come up with a conclusion. So thank you for listening, and hopefully the video was helpful. Let's meet again in the next video.